Avoid these 10 first-time homebuyer mistakes. Welcome back to another episode. I'm Mike with Martin Mike Properties, and today I want to talk to you about the 10 mistakes I normally see first-time homebuyers make and how to avoid them. Now, we have done a lot of great content as far as getting pre-approved for a loan, conduct your home inspection. So check out those videos. But I want to dive in deeper today. I'm not talking about just surface level stuff. I want to go in deep as far as what I've noticed in my almost 20-year experience in this business, that first-time homebuyers have been making these mistakes and truly how to avoid them. So let's dive in. So mistake number one that I've noticed is not truly understanding what is your monthly income. Now, here's what I mean by that. When you start shopping around for a home, you're excited, the emotions are running high. You'll talk to real estate professionals, you'll talk to mortgage brokers and loan officers, and they're all gonna say, get pre-approved. Naturally, that is the first step you should take. However, if you are a W-2 worker, a wage earner, the mortgage broker loan officer is gonna take your gross income, okay? Not your net. So let's just say, as an example, you're making $10,000 a month gross income. The mortgage officer is going to calculate based off of that $10,000 and add to any monthly obligations you have, such as car payments, credit card debt, and they take the minimum payments on their credit card debt. They're going to add all that up and they're going to give you a dollar amount that you qualify for based on your income, which is called debt to income ratio. Now, in this example, you're making $10,000 gross income. Your net is not really $10,000. It's probably around $6,500, $7,500 range. However, the mortgage broker is gonna pre-approve you off of the $10,000. So guess what? Your monthly mortgage payment is gonna be much higher. Also, if you are self-employed, you don't make X amount of dollars every single month consistently, right? So you gotta calculate what is your net, because when you qualify for a mortgage, self-employed borrowers, the lender doesn't take your gross, they take your actual net, because you obviously write off a lot of things, right? So when you're buying a home as a self-employed borrower, take the last, say, 12 to 24 months of your income that you've actually deposited in the bank and figure out what is your monthly average. Because you have good seasons, you have bad seasons, right? So you want to make sure that you're in your comfort zone. I always tell my clients, when you're buying a property, you're not buying a home just to live in the four walls. You still want to enjoy life. You still want to travel. You still want to go out. So make sure you calculate what is your actual net and what are you comfortable having a monthly payment with property taxes and insurance. So as a rule of thumb, a lot of financial advisors will tell you, have your monthly mortgage payment, tax, and insurance be roughly between 25 to 35% of your net monthly income. Naturally, the lower the percentage, the better for you. So try to stick around that 25 to 30%. So when you're start looking for a home, whatever your dollar amount is your net, take 25-30% and make that your budget. Mistake number two is not maintaining an emergency fund. Now, it's very natural when you start looking for a home, you're excited to buy a property. Just make sure you don't drain every money you have in the bank. Life happens, folks. God forbid you might get into an accident, your car breaks down, someone might get sick, whatever. You might get laid off. God forbid, anything could happen. Just make sure you maintain an emergency fund. At least have 6 months of your cost of living, okay? Whatever your property tax, insurance, plus all your other bills, try to have at least 6 months of reserves in the bank for emergency days. Life happens. Number three is try to resist immediate remodeling. Now, everyone's life is different. Everyone has different circumstances and financial capabilities. What I've noticed in my career is if you have the money, go for it. Remodel the house before you move in, spend all the money, update that kitchen, update the bathroom. As long as you can afford doing the remodeling, putting your down payment, and having your emergency funds, go for it. However, if you have enough saved for the down payment and just maybe a little cushion left over for your emergency fund, I would avoid doing major remodeling, at least for the first year to 2 years. And here's what I mean by that. Once you start living in a property, you'll start getting a sense of what you like about the home and what you don't like about the home. Even if you remodel, like myself, we remodeled the entire property when we moved in. I don't even have a plug in my closet. I totally forgot to put a plug in my master bedroom closet. So I had to redo everything. So once you start living in a property, you'll notice things that, hey, I like this style, I want to change this, maybe I want to knock out this wall. You'll get a feel of your home. So live in it for about a year or two, collect more money, have your emergency funds, And then once you have the funds for the remodeling, then do your remodeling. Number 4, factor in additional monthly costs. Now, your financial obligation does not just end with the mortgage payment when you buy a property. If you're buying a single family home, as an example, if you have a backyard and you are just busy, you don't have the time to maintain it, guess what? You can hire a gardener, right? Average gardener fee in the San Fernando Valley is anywhere between $100 to $150 a month. So that adds up. If you have a pool, guess what? Your pool service is going to run you at least $120 to $150 a month. So you already have that additional $300 extra expense every month on top of your mortgage payment. Well, guess what? Electricity, power, all of that, water bill, all of that increases your monthly expenses. So be mindful of those. Number 5 is choosing the right insurance coverage. You may think this is silly, but I am shocked how often this mistake is made by first-time buyers. It's natural. As a first-time buyer, you're excited to get the keys and you're a little fearful that your monthly obligation is a little higher than normal and you want to save a few dollars. Guess what you normally do? When you're shopping around for an insurance quote, most buyers tend to pick the cheapest quote. Why? Because they want to save a few $100s a year. Well, guess what? That's a big no-no. You want to make sure you have enough insurance coverage for the dwelling. God forbid if your property burns down. Is it enough coverage for you to rebuild that property? Especially with cost of material being so expensive, make sure you have the proper coverage. If anything goes wrong, that you could rebuild your property without any issue. So don't be afraid. Pay that extra few $100s a year, but get proper insurance. Number 6 is, should you impound your property tax insurance or not? Now here's the situation. When you buy a property, you don't just have your mortgage payment to the bank, the principal and interest payment. You also have additional costs, which is your property tax and property insurance. In LA County, the average rate is 1.25 of the purchase price. So be mindful of that. So as an example, let's say you're buying $1 million property in LA County, which is the average nowadays. 1.25% is $12,500. That's your annual property tax bill. You get a bill sent to you twice a year. It's sent and is due in November, delinquent by December, and you get a bill in February, delinquent by April. That's your property tax bill. You also have your homeowner's insurance bill, right? The hazard insurance I mentioned earlier. You pay for that annually. Now, when you're buying a property, you have the option, if you're putting a larger down payment, do you want to include those costs in your monthly mortgage payment, or do you want to pay separately? Certain buyers like to have that, peace of mind, not worrying about paying additional costs down the line. They tell the lender, hey, impound my taxes and insurance. Basically, every month when I send you the bill, I want my property tax and insurance to be paid for, which is great. If you're responsible, you feel you're okay with the higher monthly mortgage payment, go for it. On the flip side, I have clients that they try to keep their monthly mortgage payment on the lower end, and they feel like they're comfortable paying the property tax on their own and paying for the insurance on their own. Well, guess what? You have to be responsible. In this specific example, that $12,500, you're going to get a bill for over $6,000 twice a year. On top of your cost of living, when it's due in November, are you comfortable writing a $6,000 check? Make sure you budget correctly throughout the year, so when your property tax is due and your insurance is due, you have the funds available to make those additional payments with peace and not stress about it. Number 7, it may sound silly and simple, but it's trust your instincts when you're house hunting. When you start house hunting, make sure you know what is specifically important to you. Have your must wants and needs down. And here's what I mean by that. I've noticed in my career where during the first showing or the first few weeks out, I show my clients a property. It literally checks every box for them. They told me everything they want and that property is perfect for them. Well, guess what happens? They usually will say, Mike, we just started the process and, I love this property, but let's continue looking. There might be something better out there. Guess what happens? We may be looking at properties for another few months and they're comparing every home to that one property that they missed out on. So my point is, if a property meets your budget, you feel comfortable with the payment, it literally checks off all your needs. It doesn't matter if it's your first time looking at homes or a year. Pull the trigger. You gotta feel comfortable. If you're happy with it, make the offer. And by the way, guess what happens? After a few extra months of searching, they end up settling for something else because they missed out on the most important home. Number 8 is one of my favorites. Get to know the neighborhood. Now, here's what typically happens. When a buyer sees a property they love, they usually, most of the time, are looking at it during the day. And they end up loving the property. Best case, they may go out, have a second showing, and they end up telling their real estate professional, hey, let's make our offer. Your offer gets accepted. Congratulations. Guess what? You're going to go back to the house maybe a second or third time during the inspections, and usually by the fourth time, you get the keys to your home. But did you really take the time to get to know the neighborhood? Did you drive by in the evenings? Did you get a sense of, what type of neighbors do you have? I always tell my clients, hey, I know it might be a little uncomfortable, but knock on the doors, ask a few of the neighbors, hey, how is the neighborhood? What is it that you specifically love about this area? What don't you like about this area? Guess what? Those neighbors will share more information with you than the seller's agent and the seller. So really take the time, drive by in the evenings, drive by during the weekends, and talk to a few neighbors. You'll learn all the good, the bad, and the ugly about every single neighborhood. Number 9 is avoid the mistake of not educating yourself on the entire buying process. It puzzles me how often I meet buyers that, they just search online and right away they want to look at properties, but they have no idea what is an escrow, what is a title company, what are the contingencies you have to protect your earnest money deposit. So take your time, educate yourself, learn the good things about buying a home. What are the negative? What are the risks? See what makes sense for you, because everyone is in a different place in life. You got to figure out what's important to you and what makes sense for you and your family. So take the time, get educated. We love conducting first-time buyer consultations where we literally explain from A to Z what it takes to buy a property. And at times, certain buyers don't buy, which is fine because maybe it wasn't the right time for them. And the other times, we have the buyers are getting excited. They're like, Mike, I can't believe you share so much knowledge with us. Now we know, so you're not surprised during the escrow process. So take the time, get educated. And number 10 is look at real estate as a long-term investment. Buying a property is an emotional rush. It's a huge financial responsibility, but you want to make sure that you make the right decision. Look at real estate as a long-term investment. If you are, for example, thinking about getting married and having kids in the future, don't go out and buy a one-bedroom condo just to be in the game. I hear all the time, at least buy a property, get in the game. Yes, but you got to look at what stage you are in life. So if you're going to get married in the next 6 months and you're planning on having kids, maybe buying a one-bedroom condo is not the right decision, because guess what? You're going to be forced to make a decision to sell the property. And it might make money, you might lose money. So figure out what phase you are in your life and look at real estate as a long-term investment. So there you have it, the 10 common mistakes first-time home buyers make that I've noticed and how to avoid them. Comment below, subscribe to our YouTube channel, and follow us on other social media platforms. And if you're thinking about buying a home in the Los Angeles area, specifically in the San Fernando Valley, our team is excited to be of service to you. Our information is in the description below. Reach out and I'll see you at the next video.